Ever feel like everyone on your feed is suddenly a financial genius? You see people screaming about buying the dip, obsessing over tech stocks, or bragging about their portfolios. But if you're sitting there wondering, wait, what exactly are they actually buying? You are definitely not alone. Today, we are stripping away the confusing Wall Street jargon and breaking down the stock market into terms that actually make sense. Because at its core, a stock isn't just a random line on a chart. It's something way cooler. 1. What is a stock really? Simply put, a stock represents ownership. When you buy a stock, you are literally buying a tiny piece of a real-world business. Think of your favorite global megacorporation like a massive pizza cut into millions of microscopic slices. Each one of those slices is what we call a share. If you buy one share, you own one slice of that giant corporate pizza. Quick math. If a company hypothetically only had 100 shares in total, and you bought 20 of them, you'd legally own 20% of the entire company. In the real world, massive companies have billions of shares, so your slice might be tiny, but the concept is exactly the same. You succeed when they succeed. 2. Why do companies sell slices? Now, why would a massive company want to hand over pieces of itself to strangers on the internet? 2 words: growth cash. Building an empire is incredibly expensive. Companies need money to design new tech, build factories, or expand globally. They could take out a massive bank loan, but then they're stuck paying it back with brutal interest rates. Instead, they choose to sell shares. The money they raise from selling these slices belongs to the company permanently to fund their growth. They don't have to pay it back. Let's look at a quick story. Meet Leo. Leo has a brilliant idea for a premium, eco-friendly coffee brand called Green Bean Roasters. To launch his flagship cafe, he needs $200,000. He only has $100,000 of his own savings. Instead of going to a bank, Leo divides his business into 10 equal slices, or shares, valued at $20,000 each. He keeps 5 shares for himself because of his $100,000 investment and sells the other 5 to investors who believe in his vision. An investor named Maya loves the idea and buys 1 share for $20,000. She now officially owns 10% of Green Bean Roasters. Fast forward 5 years. The brand explodes. They've opened 10 new locations, and the entire business is now valued at $600,000. Remember Maya's 10% share that she bought for $20,000? It's now worth $60,000. If she sells it to another investor, she just walked away with a clean $40,000 profit. But wait, risk is a real thing. If Green Bean Roasters struggled and the company's value dropped to $100,000 total, Maya's 10% chunk would only be worth $10,000. She'd be down $10,000. That is the stock market in a nutshell, just scaled up to a global level. 3. The 2 flavors of stocks. Flavor 1. Common stock, the general admission ticket. What it is. This is what 99% of people are talking about when they say they buy stocks. The perk. You get voting rights. 1 share equals 1 vote to help elect the board of directors. It also has the highest potential for massive growth. If the company skies to the moon, your money does too. The risk. If the company goes completely bankrupt, common stockholders are the absolute last in line to get paid back. You could lose everything. Flavor 2. Preferred stock, the VIP pass. What it is, the more conservative, reliable sibling. The perk, you get guaranteed, fixed payouts called dividends, which is just a company sharing its daily profits directly with you. If things go south, you get paid back before the common stockholders. The trade-off, you usually don't get voting rights, and your shares won't experience that wild, explosive growth potential. It's all about steady, predictable income. So, why do people choose the roller coaster of the stock market over a perfectly safe bank account? It comes down to beating inflation and building wealth. A standard savings account might give you a tiny 1% or 2% return a year. Historically, the stock market has returned an average of about 7% to 10% per year over the long haul. The golden rule to remember is this: don't treat the market like a casino. When you buy a stock, look for businesses you actually understand, test, and believe in. And never put all your eggs in one single basket. Diversification is your best friend. If this video made the stock market click for you, do me a huge favor. Mash that like button and hit subscribe so you don't miss our upcoming breakdowns. Drop a comment below. What is one financial concept or term that still confuses you? Let's break it down in the next video. Thanks for watching, and I'll see you next time.